Everybody, welcome to June monthly update time. A lot to talk about today. We have a war in Iran. We have rising oil prices. We have rising interest rates. We have rising inflation. We have a stock market at all-time highs and a lot of other stuff. So is the stock market going to go up forever, or are we going to have a correction? We'll talk about it. Let's get into it. All right, here we go. So here we, let's start on just the overall chart of the S&P, get our bearings. Back here is the low from 2022. Up here is where we're at today. So when we look at what's happening with the market right now, generally across all the potential threats to the market, specifically rising interest rates, the war with Iran, rising oil prices, potentially jobs being replaced by AI, all of these things that are out there that are potential threats, they're all not having a huge effect on the market right now, and they're all actually not as bad as people thought they would be. I mean, the war with Iran seems to be somewhat calming down in a big way. Oil is still elevated, and that's going to lead to kind of like the main risk factor that I think the market is going to run into over the next 6 months or a year, is just the spending power and inflation of goods out there is starting to catch up with people, it seems. Credit card balances are at their highest levels in maybe ever, but in a long time. Default rates on credit cards are rising dramatically. It doesn't seem like there are layoffs happening right now, but there's also, even this morning, there was a really strong jobs number that a lot more jobs were created than expected last month. So it's not, things are not as bad as people were kind of thinking they would be. But that being said, we still think that the market's probably in the mood for some sort of a correction sometime soon, just like we said last month. But the good news is it's likely just more for mechanical reasons, meaning that we've moved up a lot and it very kind of sharply, and I'll kind of go through the chart in a second, but we've moved up sharply, and when markets correct for mechanical reasons, just listen, things went up a lot and now we got to take some profits. It doesn't mean that anything necessarily is falling apart with the economy, or corporate earnings are still very strong. So everything looks good, except for just kind of mechanically the market's overpriced a little bit, and this needs to correct every once in a while. That is about the best kind of correction you can hope for, because they don't last very long. So that's what we can look at right now. So again, this is the low of 2022. It's kind of where we're at right now. So I think one good way of looking at kind of where we're at in the market is we can draw kind of a channel. We often look at trend lines to gauge, kind of where we're at support wise in the market. So here's kind of one trend line since the bottom of the 2022 low. Trend lines also work though on above trends, meaning that the top end of the trend. So we can also draw one that's pretty strong. That's right here. So this trend line is hit 1, 2, 3, 4, 5, 6, 7 times now. So that's a pretty established trend line. But you can also see it forms a very kind of established channel that the market's been trading or kind of drifting through for the most part, except for just a blip right here, for the past 4 years. And you can obviously see that we're at the very, very tippy top of the channel right now, and just starting to kind of come down off of that top. So this is kind of a good gauge of where where the market could end up at some point in the middle of whatever correction that we do get. If we kind of zoom in a little bit closer to make it a little more granular. So this trend line we were watching for a long time, back in late 23 or early 24, that hit 1, 2, 3, 4, 5, finally broke through. That trend line then became resistance once it kind of gotten broken through, tried to break back, couldn't do it. That led to this. But again, this was more related to the market making just kind of a big move off of a low. Nothing was really happening fundamentally in the economy and earnings, whatever it is. So it didn't last very long. This is a sharp pullback, sharp recovery. This is actually when kind of tariffs happened, but that's the funny thing about corrections is, everyone gets prepared for like the market's going to correct at some point, and the thing that makes it correct is usually not something that is even on the radar of being a possibility of what might cause that correction. Like back in 2000, like late 2019, with the pandemic, the market was on fire again. It was making new highs almost every single day. People were saying it was going to, it's overvalued, it's going to correct. And then all of a sudden a pandemic happens, and that is what causes the correction. No one saw that coming, of course. But it's always, it's a lot of times it's just something that you're not seeing. So all of a sudden Trump decides he wants to do tariffs, and maybe that was kind of, you could argue that could have been foreseen, but either way, kind of caught the market by surprise, big pullback. And then we kind of, again, made another kind of a big move off the lows, had a more shallow, but during this correction, it felt pretty steep correction here. And now we've made a pretty much, kind of like a vertical takeoff from that low. So if you look at like the slope of this trend line, compared to the slope of the trend line that we're currently in right now, I mean, it's different. We've gone pretty much straight up, and if we zoom even closer, like we're seeing the trend line break right now. So if you remember from our last video, kind of around this area, we kind of thought like market likely drifts up for the next few weeks. Finds somewhat of a top. I think the market probably drifted higher than most people were expecting. But the fact is, we've now broken through this trend line that is very steep. To try to break back through this trend line, I mean, the market would have to basically go straight vertical again for a while. That's not going to happen. So we can assume at this point that this trend is broken, and we know what that means. That means that we typically get a period of weakness, and that's fine. That's what happens with the market all the time. But again, the good news is, like this time and the time before, it's not for any fundamental reasons, so it shouldn't last too terribly long. It shouldn't be too terribly severe. So we can assume that maybe the market fades down to, if we look at from the levels from before, this is a pretty solid area of support. Now that we've moved up past this breakout level could also provide some support level right there. Previous breakout levels often provide support. If we look at like this breakout level here, once the market broke through, came back, retested this breakout level, and then went again. So you could assume that the first kind of point of support for this market would be this breakout level, which would also line up with this long-term trend line more than likely. So market fades down here for a while, probably meets this trend line at the same time that it's meeting this breakout level, and then that could be where we find support and start to move higher again. And timing for that, could be, my guess would probably be we have a fairly weak summer, and then sometime towards the end of the year we start to find support and we start to move higher, and then we could be at new all-time highs by late this year, and then have a really good year next year, assuming that the market fundamentals stay intact. And with the way things look, I mean, corporate earnings are rising, not falling. Companies are becoming more profitable. AI is making companies more profitable. And it's not even, AI is right now anyway, is not making companies more profitable because of layoffs. It's not just like they're firing people and they're saving money on salaries so they're more profitable. It's making them more profitable because they're more efficient, and they're able to manufacture and implement and invent and all the stuff just at a quicker pace than they used to be able to. So it's just they're becoming better companies. They're not necessarily becoming like smaller headcount companies, which is great, because the one major problem that could affect the market, not in the next 6 months, but in the next 6 years, is going to be if too many people get replaced by AI, then there's going to be that could cause a massive problem in the overall economy, because the U.S. economy a lot of the U.S. stock market is a consumption-based stock market, meaning that it depends on people spending money. And if people don't have jobs, they don't spend money. And if people don't spend money, the market really, really won't respond well to that. So we need to figure out a solution to that at some point. But so far, it looks like AI is not replacing jobs. It's just making people that already have jobs much more efficient and much more productive at their current jobs, which is going to work out really well for the market, I think, for the next couple years anyway. So that's kind of where we're at. We're at the very tippy top of a channel. We're kind of rolling over a little bit from a very sharp incline. Oil prices still elevated, but market doesn't seem to care too much about that. Interest rates, the reason the market's down kind of sharply today, and it's because interest rates have risen, and they rose, though, for a good reason as opposed to a bad reason. They rose because the jobs number was so expensive that people have confidence in the economy, and when that happens, people sell bonds because they're no longer worried, and and when bonds get sold, rates go up. So that's why rates are going up today, which is a good reason as opposed to a bad. But either way, growthy kind of tech style names or stocks don't like high rates. So when rates go up, they tend to have a knee-jerk reaction down. Shouldn't last very long either. But we don't want rates to go up too much. That would be a problem just for the overall market. But that, again, doesn't seem to be a huge risk factor that's in front of us right now. So all in all, things look pretty solid and pretty put together, and hopefully we stay that way. So that's what I have for you. If you want to talk more specifically about either your portfolio, the market, whatever it is, don't hesitate to reach out. Schedule a meeting with me whenever you'd like, and we'll jump on Zoom and chat. Hope everyone's doing well. We'll talk soon.